Okay. Good afternoon, everyone. Thank you so much for being here. We're going to give it just a really quick moment to get everyone in from the waiting room, and then we'll get started. We're super excited about our presentations for today, so I don't want to take any more time away from that than I have to. So I will say this as everyone is coming in. Um, Today, Ryan Coleman cannot be here, but he'll join us a little later. He is our president. We're very excited to have Bob Zachmeier here. And he will be talking about, is it time to take the chips off the table? So we'll be very curious to hear what he has to say about that. He gave us a little preview, and I have to say it's interesting times, and he'll explain that and what that he thinks that might mean and how we may be able to move forward and really take advantage of some opportunities. And then of course, Charles will be here to talk about all of the legislative changes and things that are happening on that front. Just to let you know, there will be some things that we talk about today that are financial in nature, but none of this is advice. It is opinion. It is our experience, but we are not giving advice in any way. Same thing on the legal advice. If you need legal or financial advice, we ask that you see someone in your area that can give you an opinion that matters to you and works for you. We are the National Real Estate Investors Association. If this is your first time with us, we're a nonprofit association. We've been around for over 35, 36 years now. We have over 120 local groups and about 40,000 plus members across the nation. And we're very thankful that you're here. We also want to thank our sponsors, the Home Depot Pro, where we have a great relationship. We have special programs for investors that are through the Home Depot Pro program. And it includes things like discounts of paint up to 20% off at the register, rebates around 2% for that, and other exclusive programs, including appliances and cabinet programs. So there are all kinds of goodies that also come through the program. And you can find out more about that at your local group. And you would need to connect with your local group to take advantage of that. So if you are looking for a local association so that you can get those benefits and more, then you just come to the National REIA website at nationalreia.org, and you click here that you're an investor. You'll get this button and you can click on find a local REIA. But for now, we also have the banner at the top for the COVID-19 information, where we're keeping you updated on all things that you need to know as we are coming through, hopefully, the end of this pandemic, but keeping you up to date on things that are the results of the challenges that we've been having. So like I said, you can find your local REIA there, or you can contact us directly. But now I'm going to turn it over to the important people for the day. And Charles, do you want to give us a real quick legislative update? And then we'll turn it over to Bob.
Real quick.
Well, not real quick. I understand there's more to talk about than real quick, but you know what I mean.
Yeah, so let me share my screen here and just show everyone, before I start, Rebecca, you mentioned about coming through this whole thing, and I was really laughing the other day because the Ohio Attorney General, when the mask mandate dropped, tweeted a picture of him burning his mask. So I thought that was an interesting way to start off and say, okay, you're done with this piece of it. So hopefully he doesn't need that in the future. So, all right, let's see. Get this thing actually start going for me. Somebody asked the other day, I just throw this up there as a reminder, what is it we're doing? And kind of a little humorous way of showing this. We've seen some other people comment on this, especially when it comes to the other side and what they say we do. It's horrible capitalist people and what they do to people, and housing is a right, and well, okay, what does that look like? So interesting, but a lot of it comes down to, as several of you know, sitting in meetings and really listening and really paying attention and getting that information out to folks. So we want to follow up on a couple of things. Right now, there's movement and there's not movement. The eviction moratorium has not yet been extended to September. I expect it to be soon. There is an issue coming to a head in the Washington appeals court process here. There's some information going back and forth. In fact, the 22 state attorneys general actually sent in their letter requesting that the eviction moratorium be extended. And again, these are blue state attorneys generals that sent these letters in. And the reason they were doing that is because the government and the administration were saying, hey, we're getting a lot of pressure on this. Please give us some cover because it's more than likely going to go forward. The House and Senate are both holding hearings on evictions. Interestingly enough, part of what they're holding the hearings regarding isn't the eviction itself, it's regarding fraud and people who were supposedly evicted during the eviction ban. So hold on. I would expect sometime in the next week to 10 days, we get more information on this issue and specifically probably an extension of the CDC moratorium. In fact, one of the things you'll find, previously we had about 42 states that actually had different types of moratoriums in place. That has dropped. We're now down at 14. Without reading this, you can see it, but this is where we're at. There's expectation that some of them are going to be ending soon. Some will go on, but this is where we're at. Hopefully it continues to narrow down. This is part of why I want to tell you that if you remember, the foreclosure moratorium and the eviction moratorium were paired up to both end at the end of June. The foreclosure moratorium has already been extended. And as Brad shows in some of the real estate investing today articles, the increase in zombie houses has been pretty substantial, but there has been an extension in the moratoriums for foreclosures, and you're likely to see a pairing of that with evictions being extended. These funds have come out, and it's something important I want to point out. You got the $25 billion on one side. That's the first round that came out in December. The $21.5 billion came out in March, and those funds, the March funds, are actually less restrictive. It's an interesting mix because people who do not qualify under the first 25 billion may still qualify under the second round, or emergency rental assistance, as they call it, ERA. So just be aware of that. We have links on there on the Real Estate Investing Today for some of the things. I've got it up here on the site. Average grant so far going out in the first quarter of this year has been about $4,600. Again, that's going to change. Hopefully this keeps going out. And something I want to mention, when one of the eviction, or I should say, excuse me, the emergency rental assistance groups reach out, what they're going to do is they're going to ask for a couple of things. If the property is in your personal name, they are going to ask for a social security number. If it is in an LLC or corporate, they're going to ask for an EIN. They're going to ask for those because this is money coming to you. They have to track it. They have to go back to Treasury and let them know who has it. So if you hold up and slow down on that process or don't respond quickly, that's just going to slow down the process of getting the funds to you. I have heard from on kind of the alternative side, I've heard from a lot of property owners who are receiving checks. Sometimes the checks say who it's for. Sometimes they don't say who it's for. Sometimes they don't say why it's that amount. And the property owner is left kind of scratching their head going, okay, I've got this amount of money for this person. It does not match up with what they owe. So work through that, communicate, reach out to the group and communicate with the best you can. This is the most troubling thing. And what we don't want to have is, you'll notice I said slow disbursement out here. That's going to be the justification that they will most likely use for extending the moratoria. These are a couple of things I want to highlight. There's two themes. We've talked about this before COVID. They are extremely strong right now, whether it's the cancel rent stuff in the affordable housing or just talking about the price of housing. Now, I'll defer to some of that with Bob later on. We can talk about the economics of it, but the reality is the anti-eviction piece, right to counsel. This is a piece I want to focus on. There's some of these other ones we'll touch on, but something you want to know is this. These are the states that are passing it. These are where we're at with it. Right to counsel, when you counter that argument, the best thing you can say, and so what we've heard so far is really bluntly, simply put, you can either give money to attorneys to slow down the inevitable process of eviction, or you can assist somebody with rental assistance and actually help them stay in their housing and stay stable. That's as simple as it gets. When you put that kind of a horns of dilemma out there for them, a lot of elected officials say, no, I'd rather make sure they're getting rental assistance and their housing stable, not just throwing money to attorneys. So bear that in mind for an argument. New Secretary Fudge has announced a couple of things. She is going to be very aggressive in replacing rules that were changed in the last administration and moving things forward rather quickly. The bottom line there, or second to bottom, where it says a robust definition, expect to see some very strong language. What the Obama administration HUD offices had in place and initially laid forward, expect to see the Biden administration really ramp up and reinforce. So that's what we're seeing at this time. I do want to mention this. There is a bill, and so I was up in DC this week, and we were actually at the Capitol during the Juneteenth vote on Wednesday. And it was interesting because at one point I see Congresswoman AOC come through, and I saw another very conservative Republican congressman walking with her. And the two of them were chatting and laughing and such. And you go, so what? Well, as we get back into actually working together and people get relationships going, it's a lot harder to just slam people for being, oh, they're just a wacko up, when you got to work with them and see them more often. And that leads us to much more actual bipartisan agreements and less stereotyping and more solutions. And heaven knows we need some of that. So one of those, Section 8 reform in the Senate, it's moving forward with these two senators have already got on board. There is a House piece moving that will most likely come as a companion bill, and they're working on who's actually going to be involved with that, both the House and the Republicans and the Democrat side. This is the bill you're going to hear about most of this year. This is THUD bill. Some people call it THUD bill, transportation and HUD. 1.9 trillion. There's a lot of battles on this one. The Senate is really where the discussion is going to be. The House is going to be passing it, moving something forward. Honestly, it's really what happens in the Senate. Presently, some senators have sat down and they have agreements ranging from anywhere from about $800 billion up to about $1.2, $1.3 trillion. Part of this depends on whether you're talking kind of bricks and mortar. Are we talking concrete and steel for bridges, or are we talking about some sort of human infrastructure, and what does that mean? That's really where the argument is at. There's an agreement that this is going to go forward at some level. The question will be is how much. So hold on to that. Don't pay attention to what the House does on this. It really focuses in on the Senate. And one thing I will mention on the House side of things, the Democrats in the House have their majority by 4 votes. 5 Democrats recently sent a letter to Speaker Pelosi and just said, we are very concerned about the deficit and where this is going with spending. The budget has to be brought under control. And that was a huge shot across the bow that 5 Democrats, again, more than enough to stop a bill, were saying, we can't keep spending like this. We've got to get this brought under control. So just FYI that's out there and going on as well. That's pretty much it, Rebecca. Back to you with any questions, and we'll go from there. I'll stop sharing here.
Charles, thanks so much. You're always such a bright ray of sunshine for us.
Always with the good news.
But at least if we know the truth and we know where things are going, we can begin to prepare and understand the challenges and opportunities. So speaking of challenges and opportunities, we were so excited when Bob Zachmeier agreed to be with us today. He's been with us on cruise before. He's done several education sessions. He's very well known and respected in the industry. So we were thrilled that he was able to make time to be with all of us today and talk about what he's seeing and kind of the craziness that is different than at least I've seen in our markets before, and to talk about some of the strategies that he is using that may be something we want to consider and to look at timing and how things are going. So Bob, thank you for being with us, and I'm just going to turn the floor over to you and let them hear what you have to say.
Sure, thank you, Rebecca. I'm going to go ahead and share my screen. Everybody can hear okay, I guess?
Yes, sir.
All right. Let's see if I can. All right. Just wanted me to. You see that orange thing on my window?
I do, and I've never seen that before.
Let me see. Let's stop share. Share again. Okay. So Today's presentation is titled, Is it Time to Take Some Chips Off the Table? And coronavirus changed our life in 2020 and into 2021 for many people. Ben Franklin said, out of adversity comes opportunity, and not all change is bad. So one of the things that happened favorably is to counteract the virus, the Federal Reserve dropped mortgage rates to all-time lows. So I had 5 properties left, the home I live in, plus 4 rentals. And I've been doing real estate notes for quite some time, and actually over 10 years now. And my wife and I had 54 notes going into coronavirus, going into COVID. And during that time, we had 0 fail, and we had 14 pay off. So, I mean, that's a pretty good test of our strategy. And I took advantage of these low interest rates. I actually, when I purchased my home in 2003, I had gotten a HELOC, or not a HELOC, ARM, adjustable rate mortgage. And that at the time was going to save me $500 a month. And it was guaranteed, locked in for 5 years. So I had 60 payments of $500 a month. I was guaranteed to save $30,000. So I just said, I'm gonna roll the dice on the rates, and I got an adjustable rate. Well, who knew that the Great Recession was going to happen? And actually, my adjustable rate mortgage got into the low 2s during 2011, 12, 13, 14, and it wasn't until 2019 that it actually was starting to get up into the 3s and starting to push to 4. So I decided to refinance my property in November of 2019, and I got a fixed rate 15-year loan. And 3 months later, COVID happened, the rates dropped. My loan officer said, you know what, you can refi and knock a point off your rate. So I did another refinance in April, and that was April of 2020, and I just refinanced again in January of this year. I got a 2.25% loan, 15-year fixed rate locked loan. During that time, I was also refinancing all of my rental properties. The highest interest rate I have on any rental property is 3 3/8. So, it's just, I've been a landlord since 1982. Up until 4 or 5 years ago, I never had a rental property loan less than 6%. And to get all of my rental properties at less than 3%, or less than 4%, and into the less than 3.5%, is pretty amazing. The big news I have today is, as of 2 weeks ago, I am no longer a landlord for the first time since 1982. I refinanced all those properties, and then I wrapped them, and I sold them on a 6% carry, and I have a 3.25% loan. So I have a slide to show you just what that looks like. I'm still making actually more money than I was on the rental property as a landlord, and I will just get a payment every month for the next 30 years and never a phone call. So that's pretty good. But if you haven't taken advantage of these low rates, with inflation going crazy, I mean, mainly driven by fuel prices, everything that we consume is delivered by plane, train, or automobile. And the price of fuel is up 50% this year. So it's driving everything higher, including lumber and home prices and everything else. So there is anticipation the Fed is going to start acting in the second half of the year and raising the interest rates as they did prior to the 2008 recession. So a 30-year loan at a 3% rate is actually, for every $100,000 that you borrow, the payment is $421. And what's really neat about that is 171 of it on the very first payment is principal. So 40% of the payment is principal. So this is a really good time to be a homeowner. 15-year loan dropped to 2.5. I'm actually at 2.25 on mine. And the total payment of principal, $449 off of a $678 payment. So 66% of the payment is on the very first payment is principal. And I always compare that to basically, yes, your money, the $678 is going out of the checkbook pocket of your pants, but $449 is coming back into the home equity pocket. So you're really only, for every $100,000 borrowed, paying $229 a month. And that's the cheapest money in history. So home affordability is actually better than it was 14 years ago, just because of the low interest rates. So this is a chart from the FRED, the Federal Reserve Economic Data, showing the, and actually 2,000% increase from January of 1963 up until right now. The median home price nationally, $380,800 is the price. And you can see that during the recession, the prices nationally peaked at 257, then dropped down to 208, and now we are at 380. So since the recession, we are up $170,000 in home price. So the good news is that during that time when the prices were going up, the interest rates were going down. Again, this is record low territory where we are right now at 3%. And there's been an offset. So the prices increased, but the rates went lower. And prior to the recession, you were going to pay a lot higher payment. So I did a little analysis. I looked at this and I said, well, let's overlay these charts. So if you look at the prices versus the interest rates, you can definitely see prices are on a tear, but interest rates being this low, it's kind of interesting. In May of 2007, the median home price nationally was $242,200. The going interest rate at the time was 6.25%, and that would have made your payment $1,491. As of last year in May, the median price was $327. As I just showed, we're now at $380. But the interest rate at 3% is a payment of $1,379. So nationally, up until last year, that payment was a little bit lower. If you look at the $380,000 price, should have done it for this year, 380,000 right now at a 3% interest rate. Gives you a payment of $1,602. So it is about $109 more than it would have been 14 years ago, which is really minimal increase. So we're not in bubble territory or scare of a huge market downturn, in my estimation, depending upon where you live. I will definitely say there's markets in California that are in some deep trouble. And as of last week, there were 4 MLSs in the United States that were gaining inventory and dropping prices. And those 4 MLSs were in San Francisco, Oakland, San Jose, and Los Angeles County in California. So there are actually enough people. Last year, 2020 was the first year in history that California lost population. So supply and demand drives the bus, and basically there's more people leaving the state than coming in. Los Angeles County has averaged 34,000 people leaving every year, more than come in, so for 4 years in a row now. So they're down 120,000 people, 120, or actually about 130,000 people from when in 4 years ago. So what does that do to houses? There's more homes, than there are people looking for them, and the inventory is starting to grow. So now this is the United States. I did this. I'm from Tucson, Arizona, and our market in 2007 was 221,250 at a 6.25% rate. That would have gotten you a 1362 payment, pretty close to the national average. But as of May 20th, our price had gone to 249. So we dropped 50% of our value during the recession. And as of May, we just barely had caught back up to where we were in 07. So the average homeowner actually had a savings of $279 on the same exact house. 13 years later, the payment would have been $279 less. And that is 20% lower for a payment. Now, we just broke 300 2 months ago in our market, our median home price. And I'm going to actually share with you, I mean, since the recession, the entire nation has been increasing sharply. And part of that demand is COVID taught us something. COVID taught us you don't have to live where you work. And there's a huge surge. If you look at this chart from April of 2020, the number of people buying second homes is up 178% almost, 177.9. So you have all these people now that are saying, wow, I can keep my job and go live on a lake and look out the window and see water and a pretty sight instead of, being in some office building and fighting traffic every day. So there's a huge surge of second homes going on in the country. You have the short-term rental industry, which really started the housing shortage back in 2008. There are now just Airbnb, one company, 2.3 million households worldwide have been converted to short-term rentals. So those are homes that are not for sale on the open market. They're not for rent on the rental market. They are hotels. And to put that in perspective, I mean, look at the next largest player in the hotel industry, which is Marriott and Starwood. They have less than half the inventory that Airbnb has. So then you have the Wall Street landlords starting in 2011, 2012. Blackstone is the largest in the country. But those Wall Street companies have basically bought up properties during the recession. Everyone thought that they were going to sell them when the market recovered, but they did just the opposite. They actually collateralized them and took, sold stocks against them, raised more capital, and went out and bought more. So now the Wall Street landlords, just the 5 biggest companies, are controlling 75,000 households in America that are not on the the market for sale. They are on the market for rent, but that is taking money. All the foreclosures used to come from to Main Street, and local real estate brokers would sell them to local investors like us, who would then rehab them and either hold them as rentals or flip them. Well, now starting in about 2012, they started selling in bulk, 10,000 plus houses at a time. Fannie, Freddie, HUD. That's where most of the foreclosure inventory goes. And in this market, there are very few foreclosures just because nobody's upside down. And the home prices, even if you haven't paid during COVID, the chance that you're upside down is very minimal just because the prices have increased so sharply. So most people, homeowners in Tucson, can pull up the address of their home on Zillow, and they will find that their house has gone up on average in the last 30 days, probably $10,000. And obviously that is not a sustainable. And I've been joking for more than a year on my radio program that every day you go to work, your house makes more money than you do. And that's obviously been the case here. I'm going to show you some charts for our local market. But what's happening is the gap between the number of homes for sale and the prices is getting dangerously wide. And it's never been this far apart. And it's going to get worse before it gets better, because this demand is not a bunch of speculators, a bunch of people with liar's loans stating their income far more than they actually make. I mean, the banks are actually turning down almost 1 out of 4 homeowners who applies for a loan right now, instead of giving a loan to anybody that could fog a mirror the way it was back in 2007. So what's interesting is look at this chart put out by the Federal Housing Finance Agency. They looked at the first 5 years leading into the Great Recession, and then the 5 years leading into March of this year. And they compare them, and they, obviously different paths. The blue path is where we are right now, but look at what's happened in the last 12 months. We actually caught. So in the 5 years leading up to the Great Recession, we have actually caught the same level of appreciation, and we just passed it just last in March of this year. So a lot of people say, well, there's a bubble coming. There's a bubble coming. It's like, no, the fundamentals, as I just illustrated, the interest rates being so low, housing is based on affordability. And you had all these people, the prices went high because of speculators buying inventory they didn't intend to live in. And you don't see that level of speculation now. You actually see people moving. COVID taught us that we could be we could transition into places that we don't work. I mean, this is the biggest change to housing since after World War II, where everybody left the major cities and started going into the suburbs in the 60s and 70s, and this huge transfer into the suburbs. Now we're seeing people transferring to other states, and even though their employment stays put. So that's a huge driver of this change. It's one of those things that once you've seen it, you can't unsee it. And basically, I don't see people going back to their jobs the way they were. If they can work from home, they're going to continue to do so. So this is I pulled this on the 11th of June, and this is a 3,000 square mile area around Tucson, Arizona. And this is what our MLS covers. So I basically looked at how many single family homes under $200,000 are there. And in 3,000 square miles and a population of 1,060,000 people, there are 24 single family homes under 200. So the number of months of supply nationally is hanging right around 2 months of supply. In Tucson, we are actually at 2 weeks of supply. And then the affordability, because of the interest rates, we are actually more affordable than we were in 2012. And when the prices were at the market bottom. And then this is a chart showing the ratio of construction activity to the adult population all the way back to the 80s. And you can see that through the 2010s, that was the lowest in history. We actually are building more houses now. There's more new construction starts than there has been in this country since 2006. So the builders are finally engaged and starting to try to give us more inventory, but it's going to take a lot longer than anticipated because of the shortages of construction material. The cost of construction materials are up 70% so far this year and 340% since the start of coronavirus back in February of last year, 380%. So the average cost of a home is almost $40,000 more than it was just a little over a year ago. So these are our prices in 2019. The appreciation was 10.2%. So I just used $100,000 as a starting value just to demonstrate the appreciation rate. So we had 10.2. We were number 2 in the United States for appreciation. Last year, we were number 9 in the United States. We came in at 18.8. We were number 9 in the nation. And then this year, we're running at about 18% again. So that's a 54% increase in home prices in 3 years. So here's a question to ask. How many people got a 54.4% raise since 2019? And this is what you really have to watch in your market. And all the data that I'm sharing with you today, I actually got off of the Federal Reserve site. So if you go Google FRED, F-R-E-D, Federal Reserve Economic Data, just Google FRED St. Louis. And you will find, and then type in the name of your town and you'll find all the information on rents, on home prices, everything that you need to know to do these numbers for yourself. So this is our MLS report that just came out this week for the month of May. And what's interesting is we have 848 properties, total inventory for sale. That's single family homes, manufactured homes, condos, townhomes, everything. And we closed 1,442. So look at the inventory back 1 year ago. 2,224 homes were on the market. We are down 61.9%, but our sales went from 1,200 up to 1,442. So basically our sales increased 19% at a time where the inventory dropped by almost 62%, which is pretty amazing. Our median home price is now at $313,500. So we're still very affordable. The average sale price, $391. And then the percent of the asking price of all the homes sold, 1,500 and total homes sold, or 1,442 homes sold, they sold at 101.9% of the asking price. So everything is pretty much selling immediately. We have 0.6 months of inventory. So we're basically having to replace the inventory 2 times every month. Never seen it like this. At the bottom of the recession, the highest we ever got was a 47% absorption rate, where we were absorbing 47% of the market every month. It would take a little over 2 months to sell off the entire MLS. Now it's taking a little over 2 weeks to deplete the entire MLS. So this was all the active listings back on June 11th. So we're already down 848. And this was just like a week ago. So we're already seeing, a drop come pretty quickly. Of course, June is the busiest month of the year for real estate. And then how many of those homes were single family? 767 total for a population of 1,060,000 people. So, I mean, it's just, there's no end in sight for, the demand. I mean, that demand is going to take years to catch up. So this is something, and again, very common. This was a client of mine. I pulled up his house this week he's got a portfolio. And I said, all these properties you have that have funky floor plans, that are not on desirable lots, homes that are on busy streets, homes that are 4-bedroom, 1-bath, obsolete floor plan. It's time to take some chips off the table. You know what? This can't continue. We're almost to the point where the market melted before. I do not see a drastic downturn just because the demand is real this time. It's not a bunch of speculators. But when you reach what the normal person can afford, that's when your prices start to stagnate. And what's also anticipated is there was a panel of economists that was Housing Canary actually put out this article a few weeks ago. And I do about 2 hours of research every week on the real estate market. So I have something to talk about on my radio show. And I found this panel, and all these economists said that the consensus was that when the coronavirus moratorium was lifted, they anticipate 500,000 new homes will come on the market that are currently not available for rent because they're being lived in by somebody that isn't paying their rent. And then they're not available for sale because they're occupied by this renter. So this will, first of all, ask yourself a question. If you're a landlord and you haven't been paid for over a year, how likely are you to get that person out and go rent it to somebody else? Or are you more likely to put it on the market and sell it? So I anticipate that there will be a surge of more properties coming on the market once these tenants are evicted from the homes that they couldn't evict them with the coronavirus. So that will slow down. And this is why I'm saying take off the properties that are in a normal market would suffer. They would be sold for less if they're on a busy street, have a dysfunctional floor plan, or not in a desirable area. So right now it's the best time to sell these because there's not going to be any discount. I mean, homes that a year ago would have had 10,000 in repairs are selling for 10 and 20,000 over asking price with no repairs and an appraisal waiver. So this one was in Tucson. I have several notes, and this is actually on a note property I have in Texas, in Lancaster, Texas, which is a suburb of Dallas. And that property in the last 30 days has gone up $31,730. And then this is my personal home, 61,570. I pulled this a couple of days ago, but it's like, how sustainable is this? It isn't. And my wife says we should go live in our motorhome and sell and bail out. But this is what I'm talking about. This home I just am listing for sale next week. It's actually sitting on a half-acre town right in the middle of town. But look at around it. You've got this single-family home, and it's surrounded by apartment complexes and multiplexes. And it's just like normally that house would sell at a discount, but because of the no inventory, we can sell that house for full market value, and it's perfect timing. So this was a call to action off of my radio program that this guy has owned this home since 2014, and he said, "Yeah, I want to sell it." And normally you would suffer greatly by having all these rentals in an apartment complex literally across the street from you, and then 5 units directly across, 2 units catty corner. So but right now there's just nothing to live in and people don't have choices. So these are the kind of properties you want to look at your portfolio and say, let's take some chips off the table. Let's sell some of the properties that are the least desirable. So then this is a home that we actually bought and did a lease option on, and I purchased it back from a wholesaler. They were able to get it under contract for 90. I actually paid the wholesaler 105 for this property. And Zillow now has that house 2 years later. I mean, it's not even July yet. 2 years later, 207. And so I said, well, I don't know if I trust Zillow. Let's go look at it. I pulled the comps. Here's a 4 square mile area. And there is one active property for sale that is within 200 square feet of that little 1,007 square foot home. One property for sale, 12 being purchased right now. And look at the prices at which they're selling. That's the asking price when they got it under contract. We look at the comps, and the median for this neighborhood is 212. So this is one I was looking at. I make about $500 a month on that as a lease option. But I look at my equity and I say, how many years would it take me to pull $100,000 out at $500 a month? So basically, it's going to take me 200 months to make that on a cash flow, spendable cash flow. So now, what if I took that 100,000, invested it in a note at 7% interest? I would get $665 a month for the next 30 years. So I get more money than I was making on the lease option. I have no headaches, no hassles, no phone calls. And that particular property, the reason we want to sell that one is because it's only got one bathroom. So pretty much our whole inventory, anything that we own that has one bathroom, as soon as it comes available, if the tenant, that particular tenant got transferred out of state and
Bob, I don't know if you can hear me, but you all of a sudden went on mute, sir. Not yet.
how did I get muted?
Don't know.
Okay,
There you
can
go. You're back.
hear me now?
We can. You
Okay.
you ended, the last thing we heard is that particular tenant got transferred out of state.
Okay, the tenant got transferred out of state. We're giving them back their security deposit. We're keeping the option money. It was a non-refundable option. We're getting that house back and turning around and selling it. And basically, we will, have another $100,000 to deploy in notes. So this is a consumer price index for the rents in the United States. Pretty straight line. You saw a little bit of a dip during 2010 during the recession, but actually rents continued to climb during the downturn from 2008, 9, 10, and it just dipped a little bit in 11 when people were getting back on their feet. So rents are a nice steady increase, and there's home prices. And this data from the FRED, the Federal Reserve Economic Data, again, just Google Fred St. Louis to get the data on your town. But this information is only through the first quarter, so it ended in January. It doesn't have the rest of this year, which is going to be a big spike upward. So basically, let's just say that you had a rental property, and based on that previous chart, the purchase price back in 2010 was $222,900. So if you are a landlord, you put 20% down, you bought it, you had to put $44,500 down, and you had a loan of $178,320. So your payment on that would be $903.52 a year. So if the rent back then on that house was $1,400, and you saw the rent actually has increased in the United States across the board average by $445, which is a little over 2% a year, is what the average rent increase is. So if you look at the annual rent, it's just $1,400 times 12, but each month, and this was the actual increase based on that previous chart. So it isn't a straight line. It's actually using the rent increases that were recorded. 31% increase in rent, which is $445 from when you bought it. So most investors, most landlords who are looking at return on investment, ROI, and really what you need to be looking at is ROE, return on equity. Because if you look at this, you started at a $1,400 a month rent, which is $16,800. You put down $43,000 when you bought the place. You were actually making 37% return on your money. Now the value of the home went up and the rent went up slightly, but you paid down your mortgage. So your return on equity is actually dropping. And by the time you hit the 10th year, actually it's 11 years from 2010 to 2021, your 37% return on equity has actually gone down to 10.58. So every month that that property is in your rental inventory, you're paying down the mortgage and the value of the home has gone higher. So you have more and more equity invested. The return on your investment is dropping. So now if I look at the payment, the good news is the payment stayed the same because it was a fixed rate loan. But assuming 1.5% for taxes, 0.3% for insurance, and vacancy of 5%, and repairs of 0.5% of the value of the home, the profit on the rental in the very first year, you would have lost $8.95 for owning it. The second year, $26. And then you can see now it's making about $2,000 a year on this money. So you have a return on equity of 1% in this property if you're running it as a rental, and several of the years had a loss. So 1% net, of course, what that isn't factoring in is the appreciation. And I'll show you what that looks like here in just a second. So now here is the value of the home. You paid $222,900 for it. And then these are the actual appreciation numbers from the Federal Reserve site. And the average over the year was 4.18%. When you look at the balance on your loan, it's being paid down. And so this is what happened to your owner's equity. You started in 2010 with only $44,580 invested. But here you are 11 years later, you're sitting on $209,000 and your rent, you went up by $400, but your amount invested went up by 500%. So that's not a very good investment. You need to either refinance and take some money out or 1031 exchange into something different that has more leverage. So the median price is up 55.9% during those 11 years. Now, the rent on average increased by 2.55%, and the value of the home went up by 4.18%. But because of the leverage, because of the 5-to-1 leverage you can get on a rental property by putting 20% down on a single family home, 25% on a plex, that leverage is really pushing your equity a lot higher, the return on equity. But if you're running it as a rental, you only made $445 a year more, or a month more, $53.41 a year more. So just be aware. I mean, run the numbers on your property and do it as a return on equity, not as a return on investment. So now the rent moratorium that was put on by the CDC, and many other states had an overlay that they also took care of. Several states have already lifted it even before the CDC moratorium was struck down. But this is a perfect time to reach out to other landlords, especially those that haven't been getting paid or are worried about their ability to collect rent. And if you're looking for properties, this has been a gold mine for me, is just finding tired landlords and asking them if they would like to make more money and never have another tenant again. That's where the carryback part comes from. A lot of investors are self-employed and they can't get a loan, or they're tapped out because they have too many. So this is a really good source for property, is to find tired landlords and have them, don't buy their property from them, buy it, but have them carry and become the bank for you. So right now, rental property loans, I just sold a triplex. The person getting a bank loan with 30% down can get a 3.625% loan. That's from Jerry Sunt here in Tucson, Arizona. He's licensed in 10 states, but he does my radio show with me for the last 9 years, and his 3.6 on a rental property plex. And like I said, I got 3.25 on all of my own rental property single families. So that loan on $100,000 is 153 of it goes to principal. So you're actually making 33% on the very first payment. And this is why you want to be leveraged. I mean, the cost to have $100,000 out costs you $302 a month in interest. So why would you want to have your properties that you've owned for decades and they're all paid off? And when you can get money that inexpensively, and you could reinvest in either more properties or notes or any other investment. So this is something I did. I actually told you I sold all of my rentals. I've been tenant free for 2 weeks now. And basically the loan on this property was $121,000. I refied it, didn't take any money out, just did a cash out a refi, straight refi. 3.25, 30-year term. My payment for the next 30 years is now $526. The person that bought that property from me is a landlord that wanted to be a landlord. So they put down $50,000. I sold it for $230, and 6% interest, 30-year loan. They're paying me $1,079.16. So basically the difference, I have a difference of $59,000. That's the equity, the gross equity that I left in that deal. The difference in the rate I have and the rate that I gave the new buyer is 2.75%. So I am now making $552 a month on a house I no longer own. And if you look, my payment to the bank, I make more money a month on this house than the bank is making on this entire loan. So never a tenant, never a toilet, no vacancy, no management problems, no property tax, insurance, no more bills, $552 a month coming in for a 30-year term. And in the event it ever pays off, whatever the equity is, very, very little of it is principal in the first few years of the loan. So this is something that to also just think creatively about. And one of the benefits of this is you will have to pay your recapture no matter what. When you sell a property, you're going to pay recapture unless you do a 1031 tax deferred exchange. However, your capital gain on your property is actually, they would calculate what percentage is profit, and I only pay taxes on the percentage of the payment that's profit. So my principal, I'm actually floating the IRS for 30 years instead of getting a big tax hit right now. And I had a lot of clients. I sold 22 duplexes in my real estate business last year. And about October, I started telling people that, you don't want to sell right now. You really should wait, because if you sell now in November, you're going to close maybe in December. You're going to owe taxes and have to write the IRS this big check on April 15th. So if you wait until January to close, we can go under contract. We're just going to push the closing out to January. Now you can float the IRS for a year. You don't owe taxes on that money until April 15th of 2022. So basically you can float the government and earn enough money to pay probably half of your taxes just by timing your sale so that it starts at the very first week of January and you got all that float time to actually earn interest on the money and then pay the taxes as late as possible. So the market value of a home is determined by the number of homes that are sold in the area. The market value on a rental property, like a Plex, is determined by the income that it produces. So right now, your highest and best use of selling a rental property is to sell it with someone getting a bank loan, because that person getting a bank loan is actually going to be able to pay you probably $40,000 or $50,000 more than you could have gotten a year ago because of the low interest rates. So low interest rates do equal higher value, because that person that's going to buy that from you is going to run numbers on it. Because their debt service is less, they can pay more. So I ran a little analysis here. If you have a rental property and let's just say you have a loan on it at 5.5%, and you put $60,000 down when you bought it, which is 25%, a 180 loan, 360 payments, your payment is 1022. So your cash on cash return is 7.7%. Your ROI after all taxes is 14.3. But then what if you could go in there and refinance, or someone else could buy it from you at a 4% loan? Their payment would be $859. That's a difference of $162 a month. So then if you look at that difference and you say, you know what if I sold it for $285 instead of the $240 at 5.5% loan? Look at the payment, $1022. The payment's still lower at $285 because of this low interest rate. So we marked on this case, we marked it up by $45,000, and it's still, the numbers make sense. So this is way, later this year when interest rates are expected to rise, that $45,000 is going to vaporize. It's going to be gone forever. So definitely time to maybe recalibrate, maybe do a seller finance and carry it back on a loan. And, when you're younger and you don't have a lot of money, that leverage comes in handy. As you age, you don't want to do the hassles. You want to travel. I turned 62 in November. I'm taking my Social Security. So, I mean, I've been scaling for the last 5 years, and I finally this year accomplished my goal of selling all my rental properties. And I have way more notes and way more cash flow coming in than I ever did with rentals, and none of the headaches. So then this is why I'm just a huge proponent of doing notes. Now, granted, a note pays down every month, and over time it will pay out. However, if I wait till 62 years old to sell my rentals and I got 30-year notes, I'll be 92 if I make it that far. I think that should be enough. So I just wanted you to think with this presentation, but just remember that nothing will change if you don't. So do something to make that change. And Brian Tracy said, invest 3% of your income in yourself for self-development in order to just stay afloat and go to conferences, find out what other people are doing. I have a conference one time a year. This will be the 13th year in a row. The date just changed today, as a matter of fact. It's going to be November 5th and 6th. So in Tucson, Arizona. And every year for 12 years, I've donated 100% of the money to the Make-A-Wish Foundation. So basically you're writing a check to Make-A-Wish to come to this conference. We've raised $550,000 for Make-A-Wish just by hosting this conference. So don't take a picture of this 17 or September 16th to 18th. It's now November 5th and 6th. So if anybody has any questions, I'll be glad to jump on and answer them. And there's my contact information if you have any questions. So let's see.
Bob, thank you so much. And we do have questions in the chat bar, if you don't mind.
Yep.
Just a reminder to everybody also that Bob has a book. If you were with us on the cruise a few years ago, he actually provided those to you as a gift. So pull those back out if you haven't read them in a while, because definitely things that apply to now. But otherwise, Bob, where can they find the book?
All my books are on Amazon. I actually have 6 of them. But the one that's really relevant in this day and age is actually Who Needs the Bank? And that's, the easiest way to get it is on Amazon.
Awesome. And then we'll also put the information for the change date when we send out the replay and the slides. So you can be looking for that if you're on this call or you've registered, someone that registered for the call but didn't make it, they will get a copy of the slides and the presentation from today, and we'll put that date in there as well. So here are some of the questions. John asked, where are you finding loans for rental property to refinance? I have more than 10 rental property loans, which disqualifies me for lenders following Fannie Mae guidelines.
Okay, so I think what I mentioned earlier is the landlords that have the properties, they've learned that, that's been their income source. I always like to ask those landlords, what stock could you possibly invest in on Wall Street that you know as well as this house? I mean, you've owned this house for 20 years. So now instead of having all the maintenance headaches of owning the house, you could just be the bank on the house. And let's just ask you, how much was the security deposit of your last rent? It might be $1,400, 1 month's rent. And it's like, okay, well, what if I gave you $20,000 down? Would that be different? And it's like, yeah, what's the chance I'm going to walk away from that 20,000? But this is where I think, and also there's retirees starving to death out there with bank interest at 0.2% or less. I mean, if you put $100,000 in a bank right now, they would pay you $200 a year in interest. If you put in $1 million in the bank, you would make $2,000 a year in interest for having $1 million. That same $1 million on even a 6% note. And I have a ton of people, I have several $1 million of retirees backed up waiting to fund notes at 6%. So they would make $599 a month on the same $100,000 that the bank is paying them $16 on. So even if the owner of the home does not want to carry, you can fund that deal with private retiree money. And the reason I say retiree and not investor isn't most of the investors on this call are going to want double-digit returns on their money. Retirees are comparing me to Wells Fargo. So basically, they will go 6%. They're happier than a clam. 5% is a really good rate. I mean, think about it. If you paid them 1%, it would be 500% more than the bank is paying. When I pay them 6%, I'm paying them 30 times more than the bank pays them in interest. So there's more money out there sitting in cash than there's ever been before. And just tap that money. So if the bank doesn't want to lend to you, find somebody that will.
And along those same lines, Saeed says, why would the buyer pay you 6% while you pay 3.25 and make the difference? Is the same bank involved in the rent right?
The buyer's paying that because they actually are self-employed. They're over-the-road truckers, and they don't fit in the bank's box. They're self-employed and they have sporadic income. They, at the end of the year, they make far more than the average person makes. They just don't make it in equal increments. So,
And Bob, I think you mentioned this earlier, and we've heard this to be true. We're finding it harder and harder for even those that have high quality income bases and proof of income and great track records and great credit are still having a really big hassle getting loans right now.
you know, we just did our 5 refinances, and I got to tell you, I mean, we're in the best financial condition we've ever been in our entire life, and it was the hardest loans I've ever gotten. I had to write affidavits that the coronavirus did not affect my business. I had to do P&Ls, like, and if the loan went a couple more weeks, they want last week's P&L. I mean, it was just crazy. The amount of, it was almost as if they were looking for a way not to give me the money.
That's what we're hearing as well. So that owner financing starts looking more and more attractive. A few people had asked, what's the program that you like for analyzing that ROE that you were talking about on properties?
Well, I use Excel. I mean, the return on equity is, so basically you're going to track the value of your home. And again, you can get that data from a real estate agent or, you know, just pulling your house up and using your city's appreciation schedule that's out there on the Federal Reserve site. So once you determine the valuation of your home from the day you bought it to how much equity you have, now you look at how much balance you have left on your loan. So when you subtract the loan of what you owe from the value of your property, that tells you the equity that you have invested in that deal. Then you look at your rate of return, your rent minus all your expenses, and then multiply it times 12, and that'll tell you what your annual income is off that property. Divide the annual income into the amount of equity that you have invested in that property, and that's how you get your ROE. So it's not rocket science. I don't have a specific program. It's just, I mean, I literally did it on an Excel sheet.
Awesome. And then you mentioned the name of a lender that does your radio shows that you work with. Could you give us that name again?
Sure. His name is Jerry Sunt. He's licensed in pretty much every state west of the Mississippi except Nevada. And he's licensed in Minnesota. He did loans for my siblings in Colorado. So his name, Jerry Sunt, his contact information. He can be reached at 520-370-9576. I'm going to go ahead and type that into the chat bar.
Thank you. Give Bob a minute to do that before we pounce on him with more questions.
Somehow it went in privately. That's weird. Copy. Paste. Okay.
Okay. Saeed then had a follow-up question. Does the bank pay you every month the difference in interest you make? What happens if the buyer defaults in the payment of the monthly mortgage installment? Who will get it if it goes under foreclosure?
Well, whoever is in first position. So basically, depending upon how much money you put down, I personally will not let my retired folks, and all these loans are qualified through a licensed loan originator. So when I say I won't, it's not me, it's actually the lenders. I will not recommend that they invest more than 70% of the value of the property. So I don't know how many other investments you have that could lose 30% of their value and you would still have all your money. But that's what this is. And then basically, if the buyer did not have 30% down, I would put a second position mortgage behind it, because I run a real estate company. I mean, I could easily sell that property and and resell it again to somebody else, foreclose it and resell it. So I live in Arizona. Our foreclosure date timeline here is after it's 30 days late, you file, and it's 90-day process. So basically in 4 months, you would get the property back. So what I would do during that time is, if the person did not pay, first of all, most of my loans, the people are putting 15% down. So our median home price right now, most of the ones I lend on are under 200,000, but let's just use 200,000. If they put 15% down, they put down $30,000 cash. How long do you think it takes, a person to save 30 grand cash? So the chance of them just walking away from that cash is next to none. And if they did, then I would basically foreclose. It takes me 4 months. So I have a retiree that might have a payment of $1,000 a month that I pay for 4 months. It cost me $2,500 to foreclose, and then I get the property back, and I could, I can probably do that. We actually just had this happen on it wasn't COVID, but the Texas freeze. I had a note in the Dallas area that the lady was building a new house, and then COVID happened, and she just decided in November that she didn't have to pay and that we couldn't kick her out because of the moratorium. Well, that's not true. The moratorium is in place, but you have to have had a hardship. You have to have reached out to the landlord, and you have to have applied for state aid. And she did none of those things. So when she said that she didn't have to pay us, we took that as a challenge. And we literally in 6 weeks owned that house. And during that time, the freeze was going on and the pipes burst. And we had some water damage. We had to replace the pipes. So, most of the time this would be just this horrible, horror story. But we spent $5,500 redoing some sheetrock and replacing all the plumbing that had burst. We got that house back. We had sold it to her in 2019 for $140,000. She put down we sold it $145,000. She put down $20,000 cash to buy it, and paid us $22,000 in payments over 2 years. So she walked away from $42,000 over a $5,000 repair bill. We sold that house last week for $180,000, and we foreclosed. It was $2,500 all in. Everything out the door was less than $10,000 for everything. And our note now. The new buyer that came in put down $25,000, and we sold it for $180,000. So we have a loan for $155,000. Our old note was for $125,000. So we just made $30,000. We're making interest on $30,000 more than we ever had. Plus, we just got the $25,000 cash down payment that reimbursed us for the $10,000 that we spent on everything. So I mean, it's just like crazy. That's the horror story of the one you had to foreclose on, and it was only 2 years in.
It certainly makes you think. So Sam Wong asks, don't you have a problem with the bank when you wrap the sale?
Okay, so there is a due on sale clause. So if you go look at what the overnight lending rate is for a bank right now, it is 0.1%. So the bank is paying the Federal Reserve. Most banks are leveraged 25 to 1. So on every 100,000 that they lend out to us to get a loan, basically they have to bring in $4,000 cash, and the Federal Reserve prints off $96,000. So now the bank is paying 0.1% on that money, and the $4,000 that they had to come in with, where do you think they got that? It's from mom and pop that have their money in the bank, right? And the retirees that have their money in the bank, they're paying them 0.2%. So the bank, if they gave us a 1% loan, the bank would be making 1,000% return on the money from the Fed. If they gave us a 4% loan, they're making 4,000% return on the Fed. What's the chance that that bank wants, says, you know what, we're tired of this, like on my loans that are 3.25, we're tired of this 3,250% return. We want to go in and foreclose on the property and get the property back and not get that 3,200% return on investment anymore. So could they do that? Yes, they have the right, but not the obligation. So the due on sale clause is an option. And I right now, as I said, I mean, we've had so many notes pay off. There's not a note that I have that I couldn't write a check for if they did call it due. So I mean, there is that risk, but then let's just talk about this. So I wrapped it. Let me see if I can share my screen again. I'm going to go back to that slide. So here's my wrap. So now what happens is the loan I have from the bank is a first position note, okay, for 121,000. This buyer gave me a $30,000 down payment, or $50,000 down. I sold it for 230. And now if the bank called their loan due, I would have to find a way to pay it off. So I could either sell off part of this loan to get 121,000, or I can just write a check, pay it off. This loan is wrapped around the first loan. It's in position. What I can't do is refinance the home because it's not my house anymore. I sold it to somebody else. So when this loan is paid off, the wrap loan becomes the first. So now I can get a lending partner to buy half of the payment from me, or 3/4 of the payment. I can sell them the first 10 years of the payment. And then in 10 years, it comes back to me. I can slice and dice it however I want. But like I say, I'm not concerned at all that they're going to call it due. I mean, they're making more money than ever on the low interest rates. You know, to put this in perspective, at the time of the Great Recession, the interest rates were in the 6s, and the overnight lending rate that the banks were paying to the Fed were in the 4s. So they were making a 50% markup on the money. Right now, they're making 3,000% markup on the money.
And as you said, they have put you through such stringent processes, you know, with all of these refis. They're very, very confident with you as a borrower. It's not like, you know, we were.
One thing I will tell you is when you do get a new loan, you have to wait for it to land, because a lot of the lenders you're getting the loan from are going to sell it. You have to wait for it to get sold before you go rapid, because when they go to, to the new lender goes to record it, they're going to find this wrap, that it's been wrapped over. And one thing that I've done, if you're worried about a wrap, and I'm not a lawyer, I'm not giving legal advice, nor is National REIA, but if you deeded that house into a trust and you did not sell the trust, you did not sell the house, you sold the trust. That's not a sale.
And it's those kinds of principles, by the way, and the kind of creativeness that Bob's talking about now that you'll hear about at his conference. Those are the kinds of things that he did for us during the National REIA Cruise. So, and you'll hear about those kinds of things on the radio show as well. And Bob, people are asking, where can they find your radio show? What's the name of it? When's it on? Where can they find you?
It's on, it's a live radio show. Actually, I shouldn't say live. It's on regular radio. It's not a podcast, but it is recorded. When COVID hit, it's kind of interesting. I had a goal for 2020 to start a blog and start a podcast. And when COVID hit, all of the advertisers canceled because their businesses were shut down and they couldn't make any money. I was the only advertiser on that radio show that kept going. And they told me that they didn't have anybody. They had to lay off all the staff. They didn't have anybody to let me in the building to record my show. So they bought me all the recording equipment and I put it in my office, and I got like $700 microphones, and it's pretty cool stuff, you know? If it is on iHeartRadio, and we're actually in the process right now. I just got syndicated nationally. So anybody anywhere in the world will be able to log into iHeart and get it. If you go to knst.com, I'll put that in the chat too, knst.com. It's at 10 o'clock Pacific time on Sunday mornings. And Arizona doesn't turn their clocks back. So we're Pacific right now, but when everybody else changes, we'll be Mountain. But every Sunday, 10 o'clock, I've had that show for 9 years. And I do record the segments. I actually just came from there before I got on this call. And so I record them on Friday ever since the COVID. I haven't been in the radio station for 1.5 years.
That's awesome that you were able to keep going and that it worked out the way it did. So Congratulations on that. And we really appreciate your sharing that with us. One last question that we've gotten in the chat bar is, do you have anyone that you work with or that you are aware of on the East Coast, particularly the NYC region, that is a lender that is willing to lend right now for the kinds
Yeah,
of properties you're talking about.
Dave Putz is in New Jersey, and he buys notes all day long. So you can originate the note, and he'll buy it from you at the closing table. And Dave actually came out to my conference a couple of years ago. But I can, and there are several chat groups on Facebook that are note related chat groups, and we get people all the time that put out I've got this note, I want to sell it, I'm structuring this deal, and I've got people in my network in 26 states that all joined to learn how to invest in notes. And as I said, I've got a couple $1 million of capital backed up with retirees right now. I personally don't invest in areas that first of all, I don't invest in anything except low dollar value single family homes. And that is because that asset has the highest demand of anything in the real estate space. I mean, just ask yourself, what % of the American population would buy a 20-plex? Less than 1, right? What % would buy a duplex? Less than 8. What % would buy a small single family home? Probably like 50. So that demand, and I always tell people that real estate is like a pyramid. At the base of the pyramid are the most people that can afford the lowest priced home. And as you go higher in price, the buyer pool does this. It gets smaller and smaller and smaller. So that's why I want to be invested in, it's funny, of the more than 4 dozen notes that we have, I don't have a single loan on a house that I would live in. That's not where the money is. It's in the low dollar value. You're giving someone an opportunity to have home ownership. And, I've got people that I gave loans to a few years ago, and they are sitting on over $50,000 worth of equity. And yes, they've paid me 7% interest the whole time. Yes, they paid me $15,000 more than I could have sold that house for on the MLS. You think they're happy right about now? I gave them something nobody else would give them.
And Bob, just to, talk about the demand that you're referring to in that single family arena that is good for rental properties, even those billion-dollar companies from Wall Street that you're talking about have started running out of inventory in that arena, so much so that build to rent is now one of the fastest growing segments of that portion. It really is becoming an issue with the inventory. So if you have those kinds of properties, you're golden.
There was a subdivision up in just north of Houston that they built the entire subdivision, and as the homes were completed, they rented it out, and they waited until all the homes were built and all the homes were rented, and they sold them, and they had over 100 hedge funds fighting to buy that portfolio of rental properties from them. The builder said they would never build traditional homes again. They didn't have a single homeowner telling them what color paint they wanted or any of the headaches. They just built whatever they wanted to in the order they wanted to with no hassles. And they ended up selling that portfolio for well over what they could have gotten selling those houses retail.
Absolutely. Okay, well, I think we've covered most of the questions in the chat bar. For those of you who had gotten some answers in the chat bar and you wanted to keep those answers, make sure, because Bob put the radio show, the name of the person, and those kinds of things over there. You can save your chat bar information, but remember that you will get his slides and a recording of this if you registered for today's session. Also in the chat bar, though, were references to our blog of real estate industry updates and information that Brad Beckett, who is our staff member for communication, handles. He's awesome. He gives you new and updated information every single day. And you can find that information at www.realestateinvestingtoday.com. You can hop off our main site to get there if you forget that link. And we'd love to have you visit us there to be able to be updated and ongoing. Please remember Bob's conference. His corrected dates are here in the chat bar, and Lori will have that as well in the email. So thank you so much for being here as guests. Bob, as always, invaluable information. We loved it. We appreciate your taking the time to be with us, and we hope to have you back again soon.
All right. Thank you for having me. I appreciate it.
Thanks so much to everyone. Have a great one. Oh, and Bob, thank you for the contributions to Make-A-Wish. As an industry, it's so important that we give back to the communities and to people. We at National REIA put a lot of value in that. And that's why Bob was highlighted in our real estate journal, and then also in our ROI magazine for all that he does to give back. So thanks for your support in that. And let's support Bob in his goal for Make-A-Wish.
Yeah, I set a goal on my 50th birthday to donate $1 million to Make-A-Wish before I died. So I'm over halfway there. I need some help to get the rest.
Awesome. Okay, thanks again.
All
Have
right.
a great day, guys.
Have a great day. Thank you.